Hey everyone, my name is Jack. Welcome back to the channel. I cover a variety of topics as they relate to real estate, investing, the markets, and pretty much everything as it has to do with personal finance. So if you like that sort of content, be sure to have a look around the channel, and if you like what you see, be sure to subscribe. But today is the 15th of the month, which means it's time for another one of my M1 Finance portfolio episodes, in which I'm trying to build a $100,000 portfolio on this platform, M1 Finance. And we're getting close to 1 year on this platform, so it's been quite a ride. 2020 was quite the year, to say the least, in all sorts of different ways. But through 2020, I was still investing into this portfolio and was fine-tuning my strategies, and I'm still kind of learning about what direction I want to take with this portfolio. I think I finally found a nice groove for what I'm trying to do with this portfolio, as opposed to very early on with it, where I was just kind of shotgunning and doing a bunch of different approaches, more passive, more active, but still leaning very heavily towards passive. I'm taking much more of an active role, given what happened in 2020 with how wild valuations got and have continued to get in 2021. I just want to take a more measured approach into investing, and I have really enjoyed this whole process. But before I get into the handful of changes I made to my portfolio over the last month, I wanted to let you guys know that M1 is actually doing a nice little promotion here for M1 Plus, which is the premium service that offers you a host of benefits. They're offering it for free for the entire year if you open your account and sign up for M1 Plus by the end of January of this year, 2021. And that gets you a number of features that normally cost $125 per year, but now this is free, in which you get smart transfers, which allow you to move your money automatically based on meeting certain thresholds between your M1 Invest account and then an M1 checking account, which is free to open. It gives you 2% margin loans as opposed to the normal 3.5% margin. That is a huge perk if you have a substantial account and want to take advantage of some extra liquidity without needing to sell off. It's something I have used before already, not too expansively, but I'm going to be using it more once I start buying some more real estate whenever a good deal comes around, since deals are pretty tight in the real estate space. And then there's also an extra trading window. Normally you can only buy in the morning with M1 Finance on the free version, but with the M1 Plus version, you get an extra window at the end of the day. So it gets you that extra level of flexibility. Plus you get 1% interest on your checking account with M1 Finance, which is really nice since most high yield savings accounts aren't even at 1% right now. So that's super nice. And you also get the 1% cash back on anything you purchase using the M1 Spend debit card. This all comes with M1 Plus, which they're offering for free for a full year if you sign up before the end of January. So you might as well check it out, at least lock in your spot basically for M1 Plus. And if you ever want to use M1 Finance, if you're not using it already, then you can take advantage of it. So you might as well check it out. I have my affiliate link in the description below. If you end up signing up for M1 Finance and depositing money into your account, I might get a small commission, which would help out the channel a lot. So I'd appreciate that. At least check it out for your own good, since it is a pretty nice platform, especially for longer term investors. So back to the portfolio. I did make a number of changes over the last month. For one, I sold off the pandemic opportunity fund that I had that was mostly companies that were going for vaccines. I had Moderna in there, for example, that ended up being up like 300%, but it was such a small portion of my portfolio. It was only $500 out of 42 grand or so now. So it wasn't really doing a whole lot to the portfolio. It was a lot of companies that I really didn't do a ton of research in. It was more of a shotgun approach. One of these guys will get the vaccine and will probably do well. And it ended up working in that sense, but I'm not going to try to keep up with these companies anymore. The vaccine has already seemed to have been priced into a lot of these things, and I'd rather put it towards things that I have a better fundamental understanding of, since I'm not really following pharmaceutical and vaccine medicine-oriented companies very much anyways. I don't really have any expertise in it, and I wasn't really researching heavily into those companies. So I sold those off and moved the $500 into mainly this SPAC fund that I will show you in a moment. And I'll explain what SPACs are and the guy who runs these SPACs, that being Chamath Palihapitiya, I believe is how you say his last name. If you haven't seen him on CNBC before or anywhere, since he's very active on social media and in the media in general, he's a renowned investor who has had some serious success with these SPACs, and I'll get into that in a second. And if you want to see all of my holdings and take a look for it for yourself, or even copy it to your own M1 Finance account, I'm not a financial advisor, but if you want to use it as a starting point for your portfolio, you can, and you can adjust it as you see fit, of course. But I always link a copy of the episode's portfolio in the description below, so you can take a look there. And if you have an M1 Finance account, like I said, you can actually copy it into your portfolio and take a look there and adjust it if you want to use any portion of this. So definitely check that out if you're interested. One of my major changes that I made this time around was was I added this new stock right here, Turtle Beach Corp, which is the ticker symbol here. They do mainly gaming equipment, but you could see I bought in at around $21 per share is my average cost, or $21.30. So I am actually a little bit up on it. It's kind of swung up and down. I bought in at a couple points and my average price ended up being about $21 per share. But here's a little bit more about them. They are a gaming equipment company, but specifically they're one of the world's leading gaming audio and accessory providers. So think headphones, think mainly headphones, and generally just accessories for gaming. But if we go down to their timeline down here, you can see it's mostly gaming equipment, mainly headphones. That's their gold star product. They focus on headphones, have for a long time now. I remember when I was a kid, when the Xbox 360 came out, I think Turtle Beach headphones were paired with the Xbox 360 or something like that, to where a lot of my friends had them. I did not have an Xbox. I was a PS3 guy myself, so I did not have these headphones. But I was familiar with the brand, and sure enough, they're still kicking. And if we look at their quarterly free cash flow numbers, this is by Y charts. You can look up all this information online, which I would recommend doing before you invest in any company. See what their cash flow situation looks like. But you can see they are kind of on and off, very cyclical. This I'm not too surprised with, because being a sort of accessory company, you're going to have a lot of swings in sales. You got the holiday season that's always going to boost sales for something like this. So it's not surprising that Q1 of every year has increasingly large sales compared to the other quarters. Granted, this is only over the last few years, but it seems to be indicative of things to come. But on average, they're looking at about a $30 to $40 million annual cash flow number between all of these quarters per year. So they're cash flow positive for sure, and they seem to be on the upswing. They did really well with the rise of games like Fortnite and other games that have done really well, and they've done especially well with the rise of esports, and I think they will continue to do well in the future, because esports, I think, is still on the beginning of its growth curve. It's probably going to keep going pretty high into the near future, especially now with the virtual era. It's shown that there's a need for entertainment. You have lots of people who are gaming. You have more interest in esports. I don't see this going away anytime soon. And Business Insider has it projected, or I should say eMarketer, as put on this Business Insider article, projects that the esports digital ad revenue will rise to about $250 million. That's a lot of ad revenue, and that's not even including all the tournaments and things, all the people involved with it who buy these sorts of accessories, fans of particular teams, the teams themselves. This is a very, very large industry that's probably only going to keep getting bigger in the near future. And Turtle Beach should really benefit from this. So let's look at their balance sheet a little bit. Here's just Yahoo Finance. You don't really need to get super in depth to get basic metrics, though I would recommend looking at any company's balance sheet too. But just because I'm trying to highlight some things here, you can see that their cash is at about $27 million. And their debt is only at $5 million. Already a great start. They're not super over leveraged. They're not in a huge liquidity crisis. They could pay off their debt whenever they want. So that's great. I always like seeing that on a company's balance sheet, not super over leveraged, because that's a lot of extra risk. Sure, it could improve your returns, but so could reinvesting this cash not into debt, but rather into new products. And they could always pull out new debt if they need to, because they're in a good position. It's one thing to take advantage of debt when you already are in a good position. It's another when you're just drowning in debt, which this company does not appear to be doing. And we see down here their levered free cash flow of about $33 million over the trailing 12 months. So about between that $30 to $40 million sort of range that I said before. So if we put this into an intrinsic value calculator, I've used this before on the channel. This is actually from Investing with Tom's channel. He put this out for free, so I went ahead and started using it. It's just a discounted cash flow calculator, which takes a number of factors into consideration, including the total cash on the balance sheet, and also looks to see what you're projecting the growth rate to be and what the present value of the future cash flows are going to be, because you want to discount those based on the return you're trying to get. And this is assuming a 10% discount rate, so you'd assume a base return of about 10% if they hit all these numbers, and then nothing crazy happens with the share price. But of course, you never know in the short term, lots of things could happen. But you want to take a measured approach when you're trying to value a company. You want to make sure that you're being reasonable with what you're assuming, and that if everything pans out as you're projecting it, what's a decent price to project, as well as what happens if something doesn't happen or if things don't go very well. What's your downside? How much are you risking here? So you can see here, I only assumed a 2% growth rate over the next 10 years, and that's really nothing. We saw what esports revenue was growing to at about 15% per year, so if we can hit even close to that, we're going to be in a much better place. But let's start with 2%. Got 2% per year with a discount rate of 10%. Free cash flow currently of about $35 million. These are all in billions. Excess capital of $22 million in cash, which is the $27 million in cash minus the $5 million in debt is what I used. That gets us a present value of future cash flows at $410 million, which leaves an intrinsic value of about $430 million when you add in the excess cash and everything. And at their current market cap of $320 million, you have a nice little margin of safety there at about 35%. Again, this is assuming very little growth. Right now they're trading at about $21 per share, between 21 and 22. They've been bouncing back and forth a lot over the last couple of weeks. And I would say their intrinsic value, if they were to hit these very conservative estimates, probably today is about $29. This is a conservative estimate as well. If we bump this up, let's say to 5% over the next 5 years, which I think is totally realistic, and still keep it at 2% over the next 5 after that if there's more competition entering the space, which I'm sure there will be. Now all of a sudden the intrinsic value jumps to about $470 million, which is a 48% margin of safety. That is a pretty hefty cushion that you're starting with, which should eliminate some of your downside risk. Of course, the future is totally uncertain. I don't know what's going to happen exactly, but that's what you're hoping for when you're making these sorts of projections. And if we have a really great case, let's say 10% over the next 5 years, and maybe we'll bump this to 3 or something, now all of a sudden your margin of safety looks really great. I think there's a lot of good upside with Turtle Beach. They don't have huge downside because they don't have a ton of debt right now. Of course, sales could slump, but I think at least for the next few years, they're probably going to do pretty well with all the new console sales. We have the PS5 that just rolled out. I'm sure that will only help someone like Turtle Beach and other brands as well too, but more sales is always good for a company like this, which doesn't have a lot of debt to worry about. So more sales is going to lead to more profits, almost for sure, since they have pretty hefty margins on their products. But if we just assume that 2% growth rate, I'm very comfortable buying this at the current price of about $21.50. However, it is very volatile. If I see some more data over the next quarter, I might invest more into it. Right now, I only have a fairly small position at about $2,500 into it. I just want to stay pretty liquid in case there's better opportunities that arise. I'd say I'm a medium conviction on this trade right now. As I learn more about the company and as I learn more about the sector as well and see how it does next quarter perhaps, I might end up putting quite a bit more into it. But right now, about $2,500 into it, might double that, I'd say. I don't want this to be a huge portion of my portfolio, at least yet. I might up it beyond that, but we'll see. But right now it is making up something like 5% of this portfolio, about $2,500 out of $4,200, something like that. So it's a pretty hefty portion. I wouldn't want to get beyond probably 20% with any given trade. Right now I have the Equity Commonwealth trade that's at about 25% of this portfolio. Granted, I have other investments outside of this, so this isn't my entire portfolio, full disclosure. I do my net worth review every single month if you're curious on that on the 1st, so you can kind of see these moves in context of my greater overarching portfolio outside of M1, which I hope you would check out. So that's Turtle Beach. It's one of my bigger additions. Then we also have this Chamath SPACs slice of the pie, or I should say the pie within the pie on M1, which you can do. And I have invested about $1,500 into IPOD and IPOF. So IPOD and IPOF, which is 2 SPACs. For those of you who don't know what a SPAC is a special purpose acquisition company. This is a company that takes itself public as an entity that's basically full of cash. And then the intention is that they are going to merge with a private company to then take that private company public without having to go through the super strenuous IPO process. And it saves costs for someone trying to go public if they go through a SPAC generally. That's the goal at least. And there's been a ton of SPACs this year that have done very well. There's been a lot that have done poorly too. But the idea is that you're parking your cash with someone who will then merge it into a company that you wouldn't be able to get into otherwise without having to pay hefty fees at the back end or pay a premium on an IPO. It's probably the closest thing you can get to private equity style investing, or at least getting into IPOs very early, that you can do without having to actually be a accredited investor or someone who's actually in the private equity space. Now, there are a number of issues with fraud and incentive structures with SPACs to definitely look out for, where maybe the promoter is getting a hefty fee regardless of where they place it, and that could lead to some wrong incentives in that they'll put it at a very expensive company just so they can benefit by getting shares at a discount, whereas all the investors will be paying this premium and suffering from it. So there is risk with SPACs still, but I think the downside is a lot lower than something like just investing in a true stock, a true company, since it's just a cash vehicle. So if things go poorly, you should get your cash back, or at least you should get the intrinsic value of the share. You won't get the premium you paid on that cash, but let's say a SPAC has $100 million and it's trading at $110 million. If the SPAC somehow folds, at worst, you'd expect to only lose 10% of that value, the 10 million. So the 110 minus the 100, since all the cash would get redistributed, or at least it should. If there's fraud, that could cause bigger problems, but as long as there's no fraud, that's what you'd probably expect. Definitely do some research into whatever SPAC you're investing into. But what are these SPACs? Well, these are owned by this guy, Chamath Palihapitiya. I said it right. It is hard to say his name if you're not used to it, but he has a number of SPACs that he's taken public this year, a number that have actually merged with companies. His most recent one is merging with SoFi, and that is, I forget which one it is, IPOD, I believe, since he has 6 of these, or he has had 6 of these. 2 of them don't have any targets, which are the ones I'm invested in. Yeah, it's IPOE. This is the one that he's investing into. SoFi, which is social finance, I believe is what it's short for. Social finance, which is a fintech startup. I haven't done too much research into it. I'm not very interested in investing in a lot of tech startups right now. It's not my style of investing. I am going for more value plays. But the reason I invested in these SPACs is because of that sort of upside asymmetry. In that the downside, it should be that you get the cash value of the SPAC back if something goes wrong, unless there's fraud. That's the extra risk always. But the upside, it's pretty substantial. If we look at IPOE, the day after they announced their merger with SoFi, it basically jumped up 58%. It's currently trading about 68% over what it was. And that's before it's even merged with the company, before we even perhaps have all the information about SoFi. So they are quite speculative in that way. But what I would plan to do is, as soon as a target is announced, I'm out. I don't really care because it's probably going to be a very expensive, probably overpriced tech firm in my humble opinion. You can think otherwise. Chamath, I would say, is a master salesman, especially when it comes to Twitter, in that he is letting people know about what deals he's trying to do, and it's causing a lot of fluctuations in his stocks, I believe, especially his SPACs. When he announces that a deal might be going through, these things spike up, and if the deal falls apart, then it will go down. But there's a lot of volatility in these SPACs, even though it's just a cash vehicle, because I think there's a lot of hype behind them. That's where that asymmetry comes from on the upside. So I want to get into some of that. It might be a sort of inefficiency right now where it seems like every SPAC from guys like Chamath that actually finds a target, they seem to spike up dramatically once a target's announced. That might not be the case in the future. It might go flat, or it might even go down after it merges. It's hard to say if people don't like whatever the target is. But I'm going to use some of my cash in the meantime and park it here, and then as soon as the target's announced, I will sell out of these most likely, unless it's a company I happen to really like and it's profitable and everything, but it's kind of unlikely. If it is super profitable, then sure, we'll see what it's trading at. But he's targeting mostly tech firms, and we've seen where tech valuations are across the board. They are pretty nuts, no matter what the profitability of the company is. So you could say I'm sort of swing trading some SPACs as a replacement to my cash. That's probably the best way to characterize it. I'm not going to make this half my portfolio, but I think a little bit down here, it's worth a try. This is something I haven't done before. I'm going to see what happens. I don't think my downside's super big, though it has already dropped a little bit because these are trading at a premium, at least Chamath's are. So we'll see what happens, and I will definitely keep you posted. I'd love to hear your thoughts on that strategy, as well as if you have or are investing in any SPACs right now, since there are tons of them. They have gotten very, very, very popular over the last year, especially over the last few years, really. But 2020, they entered a new gear of expansion, so lots of people are investing in SPACs now. It seems to be the hot thing with bond yields being crushed. People have a lot of cash that they want to put somewhere, so they're giving it to these jockeys, essentially, these high-profile investors who will then take the money and hopefully put it into a good investment. That's the idea, at least. But that's pretty much it. If you like this video, definitely like it, since that would help the channel out a lot. And if you want to see all of my updates in the future about this portfolio, definitely subscribe, since I put out a new one of these episodes on the 15th of every single month, and I'll go over changes in the portfolio, as well as my rationale behind moves, and hopefully we can get a nice discussion going in the comments as well. If you have investments that you're looking at and you want to have a discussion about that, that's great too. The whole idea, at least for me, is I'm trying to become a better investor, learning through the process, seeing what great investors are doing, maybe following them sometimes, maybe changing their approach a little bit if I see something differently. That's the whole idea with investing. You are trying to not only protect your downside, but maximize your upside at the same time. And like I said before, definitely check out M1 Finance. I have my affiliate link in the description below. And I also have a number of tutorials on M1 Finance that you can check out on my channel, so definitely take a look at those. If you're new to M1 Finance, want to learn more about it, I have a breakdown of a lot of the features on there, hopefully all of them. I tried to cover everything, so definitely check those out. But until next time, take care.